1. Introduction to Basic Finance. So there are three divisions of finance. First, institutions, investments. Second, investments. And third is corporate business finance. And there are five key concepts. The first concept is source of funds. The second one is time value of money. Third one is trade-off between risk versus return. Fourth one is leverage, financial leverage, and valuation. Okay, institutions. What are the institutions? They are companies engaging the businesses of dealing with monetary transactions such as deposit, loans, investments, and currency exchange. For example, commercial banks, investment banks, insurance companies, and brokerage firms. The creation and the trade of the financial assets. They are responsible for the creation and trade of the financial assets. For example, Goldman Sachs, Morgan Stanley, and New York Stock Exchange. And the regulation of the financial markets. For example, Federal Deposit Insurance Corporation, or SEC, or FINRA. SEC is Securities Exchange Commission. FINRA is Financial Regulatory Agency. And there are many other regulatory agencies. And the one major function of the financial system is to transfer money from savers to issuers, users. From savers to users. So this transfer process creates the financial securities. The second one is investments. The study of the investments is concerned with the analysis of the individual assets and the construction of well-diversified portfolios. And it encompasses financial planning, including one's financial goals, selecting specific financial assets, and construct diversified portfolio. And other factors affecting your investment: taxation, Fed monetary policy, meaning the flow of information from public firms, publicly traded firms. The third one is corporate finance. Within a corporation, emphasize the role of the financial manager. And what is the goal of the financial manager? It explains the goal of financial manager, determine what are the best sources of the financing of the firm, determine what the capital structure fits the firm. Capital structure involves equity and debt, and allocate firms resources among alternative investment projects. So mainly corporate finance is the area of looking for corporate structure and explain the goal of financial manager. Okay, what are the sources of finance? The company needs one or multiple sources of funds to acquire assets, and the source of funds are summarized in balance sheet. And the balance sheet, in other words, a statement of financial position or statement of financial condition. And in balance sheet, you will see assets, liabilities, and equities. Assets means items of properties owned by firm, household, the government, and valued in monetary terms. We have assets, liabilities, and equities. Assets, all the items the company have. Liabilities, items that economic unit owes, expressed in monetary terms. These are the loans and credits. They're debts, actually, debts. And equity is the earnings. Items that owners invest. Okay, equity is the items that owners invest in the firm, expressed in monetary terms. Yeah, equity. Capital, actually. Equity is the capital. So what are the sources of return? That it could be income and price appreciation. The second concept is time value of money. The Benjamin Franklin says money makes money, and the money that money makes money. So a dollar received in the future is not equal to dollar received in the present, right? So what does it mean? It means times 0 times 1, is it $100 is equal to $100 in time 1. Like today, this is today. This is time 1 is, let's say, 1 year. In 1 year. What do you think? It's not equal because you can earn interest by depositing your money, and you can earn, let's say, some interest rate, and maybe you can earn 103 or 5. Okay, it's not equal. And money available at the present time, is worth more than the same amount in the future due to the potential earning capacity. Yes, and okay. Yeah. What is let me delete this. Okay. So what is interest rate? What is interest rate? Example, what is the future value of $50 in 2 months if the monthly rate is 10%? As I explained, right, you need to take into account the interest rate when you find the value of the money. This is the summary of this slide. And the third concept is risk and return. All investments are made in anticipation of earning return. It could be in the form of dividend payments, capital gain, or interest income. When invested in project, one expects to generate a cash flow and profit. And risk is uncertainty that an expected return may not be achieved. And risk is an integral part of financial decision making and will appear throughout this course, yes. And can we identify the risk or even manage them? Yes, we can. And is there any investment that involves zero risk? Risk-free? Yes. We will talk about this risk and return measures and which financial instruments has zero risk, and we will give examples like treasury, government bonds, etc. Treasury. Okay. So this figure shows the relation between the risk and return, and y-axis is return and x-axis is risk. Risk means standard deviation, and the higher the risk, the higher the return. As you see, when the risk is getting bigger and bigger, your return is getting higher. And the financial leverage, the fourth concept is financial leverage. It's a source of risk in financial decision making and use of borrowed funds in return of agreeing to pay a fixed return, use of debt financing. Leverage means how much debt company use compared to its assets or other balance sheet items in assets. So just says how much debt the company has in percentage terms. And the use of borrowed funds in return for agreeing to pay a fixed return, use of debt financing. So not only firms, governments face these financial decisions. Firms need that. Also, governments need that. And what is the disadvantage of using that? Yeah, we will talk about using having high. Maybe yeah. What is the disadvantage of that? We will talk about the details using debt and equity. And what is the advantage of using debt? Yeah. Why companies use debt, or how much debt they need to use. Okay, the key concept 5 is valuation. The return is earned in uncertain future. There has to be a way to express the future in terms of present. Yes, and the process of determining what an asset is currently worth is called valuation. The value of the asset depends on returns they generate in the future. Yes, and the value of firm depends on value of its assets. Right, and we can have valuation for public firms, private firms, small businesses. How can we do that? So we mainly look at the financial performance of the company, and it can be their income, or their cash flow, or their dividends. They pay dividends. So by looking at, let's say we're looking at dividends, and time 0, time 1, time 2, and time n, we try to find the value of the company in time 0, and we have some assumptions, and we predict the dividend payments for each time, and we try to find the value of those payments in time 0. We will explain this in the future, but we are using dividend payments or other items to value the company. So assumptions. Financial analysis is based on assumptions. For example, every year you contribute 1,000 to your retirement account. If you earn 4% annually, how much will be in the account after 10 years? So time 1, time 2, time 10. So every year you contribute 1,000, 1,000, 1,000. And you're earning 4%. So you contribute 1,000, but in 1,000 gives you 4%, and you will earn $40, right? The results of the financial models and applications of financial theory can be only as good as the accuracy of the assumptions used in the complete analysis. Yeah. So what does the financial system does? The financial cycle shows the savers and the borrowers. Savers can be individuals or institutions, and they give money to the borrowers. Those can be individuals or financial institutions, companies, maybe companies with project and a new idea. And companies also generate wages, profits, and interest to the savers. This is the cycle of the financial system. So we can show the whole financial system in this chart, the players in diamonds chart, we have financial institutions, we have financial markets, borrowers, and savers. Same, savers give money to financial institutions give the money to borrowers, firms, individuals, and firms generate rates or interests, and they give those value to the savers. So finance is the process of transferring money from savers to borrowers and transferring returns back from borrowers to savers. Okay, let's solve one problem. Okay, taxation of corporate earnings. You are a shareholder in Netflix. You buy some shares of Netflix, and Netflix earns $5 per share before tax. $5 before tax per share. $5 per share. Okay. After it has paid taxes, it will distribute the rest of the earnings to you as a dividend. We make this simplifying assumptions, but should note that most corporations retain some of their earnings for reinvestment. Okay. The dividend is income to you, so you will then pay taxes. We will pay taxes on these earnings, and the corporate tax rate is 40%. Corporate tax is 40%, and our tax rate is income tax, dividend. Yeah, our tax rate, income tax is 15%. So first question, how much of the earnings remain after all taxes are paid? And what is the effective tax rate? Just pause here and try to solve these questions, and I will solve the question. Okay, problem 1, solution. So we have $5 per share, and we're paying 40% corporate tax, meaning $2 corporate level. We pay $2 tax corporate level, and $3 is after tax earnings per share. So as an income tax, we are paying 15%, which is multiplied $3 to 15%, it is 45 cents. So it leaves us $2.55 from the original $5. So we will calculate the total effective tax rate, meaning, okay, the original income is $5. We paid $2.55. No, we paid $2.45 tax, and it leaves us $2.55. So how much total tax we paid? $2.45 divided by $5, and it equals to 45% effective tax rate. Okay, wrap up. So in this session we learned what is finance, what does the financial system do, what does time value of money mean, and what is the relationship between risk and return, and I show you the players in diamond. I recommend to read your notes, this PowerPoint slides, and chapter 1 and chapter 2, and you should complete my type exercises for chapter 1, quizzes, video reviews, PowerPoints, and flashcards. That's all for today. Thank you for your attention.